We all hate taxes, right? Because it's so annoying, and but we are forced to do it every single year. We don't understand most of it, but we have to seek help from somebody and do it every single year. With crypto, tax can get even more complicated. And in this video, I'll try and explain the basics of crypto taxation so you know exactly what you have to do, and you're not completely ignorant, and you end up with a fine or something later on. So in today's video, we'll cover what is the basics of crypto tax. If you have done some exotic things like mining, staking, etc., then we'll see if there are some other tax implications on you. We'll see if you can avoid tax, and we'll see if there are any tips for reducing tax. Right, now let's start with this. What's the most basic thing you need to know about crypto tax? Well, the first thing is tax event. You need to know if you have incurred any tax event. Now, what's a tax event? If, let's say, in real life you owned a pizza outlet, you sold pizza, then you're liable to pay taxes because you received a payment for selling pizza. Or if you're a salaried employee, you received your income every month, then you're liable to pay taxes. Now, for crypto, this could be as simple as, let's say you traded your crypto to a fiat currency like the US dollar, right? So you sold your Bitcoin, you bought, you got US dollars in return, then that's a tax event. You're liable to pay taxes. If you traded one crypto for another cryptocurrency, right? So you bought Ether using your Bitcoin, then you're liable to pay taxes. If you let's say paid for your Netflix subscription using Bitcoin, even then you have to pay taxes. That's a tax event. And if you received a part of your income in the form of crypto, even that is a tax event. So what's not a tax event? Well, holding cryptocurrency, that is not a tax event. Now, let's say you bought Bitcoin this year and you held on to it for the entire year, you did not sell it, then that's not a tax event. So you don't have to pay taxes for that. Let's say you transferred crypto from one wallet to another wallet, both of which you own, right? Now, this is equivalent to you moving your money from one of your bank accounts to another bank account, then you don't have to pay taxes, right? So same way, if you, let's say, move your cryptos from your Coinbase or Binance account to your private wallet or to your hardware wallet, then you don't really have to pay taxes on that. Using cryptocurrency as a collateral for loan. So if you, let's say, pledge your ETH or Bitcoin and you receive a loan, then you don't have to pay taxes for that. So those are some of the things which are a non-taxable event. So you need to understand what you've done in the year and know whether you have to file crypto taxes or not. Now what else? Well, if you bought and sold crypto, including stable coins, then you have to pay tax. Right? Let's take an example. So let's say in June of 2014, you bought one Bitcoin for $500. Right? Years later, you sell it for, let's say, $50,000. Then you have gained for 49,500, and that is the amount on which you'll be liable to pay taxes. So that's something that you need to keep in mind, and that is called capital gains. So there are two kinds of capital gains, right? There's short-term capital gains, which is typically less than a year. So if you bought Bitcoin, held it for less than a year, let's say you held it for 6 months and you sold it, then it'll trigger short-term capital gains. If you held on to it for a longer term, that means more than 1 year. You bought Bitcoin last year, you sold it next year, then you will be having long-term capital gains. The difference between the two is long-term capital gains are usually lesser in value. What is that exact number? I'll try and show you a table to make you understand better. But for now, that's the difference between the two. There's more, right? That's just buying crypto and selling crypto, right? Which probably most of us, especially those who are watching this channel, would have done. There are some of us who would have done way more than that. For instance, some of you might have got an airdrop, right? We spoke about Arbitrum airdrops and Optimism airdrops. So we spoke of all that, and we know that some of the viewers of this channel definitely would have got an airdrop or a forked coin, right? Or some sort of a reward. Let's say you referred a friend to a Web3 game, and the Web3 game gave you some tokens in exchange for that, as a reward. So if you have done any of this, or if you've received any of this, then that's a tax event, right? Let's take an example. Now, let's say, this is for forking, right? Now, let's say Megan received 2.5 Bitcoin Cash as a result of a Bitcoin hard fork. So Bitcoin forked, and Bitcoin Cash was what was created as a parallel blockchain, and every holder of Bitcoin received Bitcoin Cash as well. So if you got 2.5 Bitcoin Cash, the day you got it, right, that minute or that second that you got it, the value of Bitcoin Cash at that second, right, at this, let's say in this example, it is $1,250. then $1,250 is the personal income that you have to report and tell the government that, hey, this is the income. It's possible that you didn't sell it. You still have to report 1,250 as an income, and when you sell it later, there's probably capital gains on it later, but just receiving Bitcoin cash, you have to report it. All these examples are taken from CoinLedger's article. I have linked that in the description. You can go through it. Now, imagine this other example. Right now, Michael holds ETH on Voyager. Michael earns $150 of interest rewards. Right now, Mitchell. Right, Mitchell reports has to report that $150 as personal income. So even though you did not sell any ETH, you just got interest rewards for putting that somewhere. You have to report that interest reward as an income, and that's what you have to pay taxes on. Right. There are more things. Now, for instance, payment, mining, staking, crypto also attracts tax, right? We went through this example of staking here. So it's as simple as that. If any income that you receive from these will be taxed. Now it depends on what kind of a tax. For instance, if it was mining or if it was payments, then you could be liable for business, classification under business income and not really under a personal income. So that's something that maybe a tax advisor would be better, positioned to tell you based on what you have done and the quantum and so on. But for now, this is all that you have to understand. Kindness has benefits though. For instance, if you gift somebody crypto, or if you donate crypto to any charitable organization that is registered, under the country's tax laws, then you have benefits, and that donation or that gift might be exempted from taxes, right? So you could probably take it as a deduction. So that's something that you need to keep in mind. Transfer of crypto between your accounts, that is not taxed, right? So now, for instance, David buys $10,000 of Bitcoin from Coinbase. David transfers Bitcoin to his BlockFi account, but BlockFi does not know the cost basis for David's Bitcoin. Now, first of all, when you are reporting, you should tell wherever you're reporting that, hey, this BlockFi wallet as well as the Coinbase wallet, both are mine, and hence this $10,000 Bitcoin transfer that has happened is not a tax event, and you're not liable for taxes for that. The next section is, I think, something that I keep getting asked in all my classes that I take as well. Can you avoid tax? Well, the simple answer is no. You cannot avoid crypto tax. Although there's D5 and all kinds of things, the governments are also smart. It is best to not avoid it, because governments are also getting into using a lot of intelligence tools. Crypto exchanges are sharing information, so they are connecting the dots and trying to figure out who's evading tax. Right? So crypto exchanges are sharing information with governments. Right? If you're using a centralized exchange, then for sure all centralized exchanges are sharing information with the government. Now, this was something that I found in a particular article. This was, I think, an IRS presentation where they're talking about what exactly are they doing and how are they trying to detect tax evasion. So if you look at this slide that is being presented here, it says they're using data analytics to find non-compliance. They're using applied analytics section, hiring data scientists. They're using Planter, and in the case of crypto, they're probably using something like chain analysis and so on. They're using NCIU, collaboration with the IRS, BODs, collaboration with LEA, collaboration with academia. So though all these taxmen are not probably the most tech savvy people, they are definitely doing their homework, and they are using intelligence tools to track what you're up to. So somewhere in the chain you might get caught. So it's best to never avoid taxes. Just report it, and that's as good as that's probably the safest thing for you to do. And the last thing is, it's not just in your home country, right? Because crypto is borderless, but tax regulations are not. They will catch you. US citizens have to declare foreign holdings as well. So there is a particular form that you have to fill up. You don't have to pay taxes on it. So let's say you own crypto on some exchange which is not in the US. You still have to declare it. And if you don't declare it, I believe there's a fine of like $10,000 per instance or so. So there are some steep fines associated with that. Even though you don't have to pay taxes, you just have to declare it. Just make sure you go through all that and avoid any future complications. There is also something called the statute of limitations in the US. So if you declare it, then I believe there is only a certain limit, like let's say to 3 years or something, that the US government can go back. And if you don't declare it, then they can potentially go on investigating you forever. So all these are best explained by your tax advisor. So do consult with them. But this is just to give you a high level information that this is what is happening in the world. So you better be careful. So any tips for reducing taxes? Well, a few of them. Hold for a long term. That's the first one that I want to tell you, right? And why am I telling you that? Very simply, it's because of this. Right? Long-term capital gains in the US has somewhere between 0 to 20% tax. This is based on the income that you're earning. Short-term capital gains is between 10 to 37%. You can see that difference. Right? Short-term capital gains is higher. Right? Let me try and show you a table that probably has more information. Now, if you look at this, if your income is up to $20,000, then your short-term capital gains is 10%, whereas your long-term capital gains is 0%. This trend goes on depending on your income level. Your short-term capital gains will always be higher than your long-term capital gains, right? Like 37% and 20%. So you have to, one best thing for you to do is always try and hold for the long run. That would give you, some benefit in terms of taxes. The second one is borrow against your crypto. This is very interesting. Now, a lot of people, right, these months especially, where people have expenses, maybe it's the end of the year, you want to buy gifts for your family, you have to pay some fees, whatnot, you have expenses. So people tend to sell off their stocks, sell off their crypto, and then they tend to go ahead with their expenses. But if you do sell that, and if it's a short-term holding, then you might end up paying a lot of tax, and if it's a long-term holding, you might pay a smaller tax. But the better thing to do is, if you're just in need for money for a short term, then borrow against your crypto. Right? You can borrow against your crypto, and let's say you're getting money in January or February, then you can just pay it back because you will not be taxed like this huge 37% or even 10 or 20%. Right? And the interest rates for borrowing might be much lower. So do check that out. That's one option that you have. Gift it to family members, because I think in the US up to $15,000 is tax free. Do check out the exact value, but this is something that you can consider. Every year there is someone's birthday, there is somebody's anniversary, all sorts of events keep happening, family events and whatnot, and you might have to gift at some point in time, right? Each of us are probably gifting like 5-6 times in a year to our near and dear ones. Consider gifting crypto instead, because one, you get you get tax benefits for doing that, and two, think of it this way: if you gift crypto, and this is a useful gift, in the future the value appreciates, right? Let's say you gifted Bitcoin, right? One of my friends did that on his nephew's first year birthday. He gifted him crypto so that this value continuously appreciates. Instead of a random toy or something that the kid will anyway throw away, he gifted him Bitcoin so that he can hold it for a long term. And maybe when he's probably 18 years old, that Bitcoin might be enough to pay for his college education. Who knows, right? So consider gifting, substituting whatever materialistic gifts you're giving with crypto, and this could help you a lot in terms of giving you tax benefits, and might also help the person you're gifting, because this could become a long-term, growth potential for him. The last one is harvest your losses. Right now, this is a very complicated strategy. You have to, really be in it. You have to know what you're doing. Now, let's say Miles has $1,000 of capital gains for the year. He sells his Bitcoin at, now what he can do is, now this year, let's say you had $1,000 of capital gains because earlier in the year, let's say in March or something, when the prices were high, you sold it. Now prices are low. And for instance, that, or you think that for the next few months prices will be low, you can sell your Bitcoin at $1,000 loss. Right? Then you bought it, and you might be holding some other crypto, and you can sell it at a loss. You can offset this $1,000 gain with this $1,000 loss, and in January, hoping that the prices will continue to remain the same, then you can buy it back, and you would not be paying taxes on this. However, this is a very complicated strategy. It requires some understanding of where will the market move. And also, will it benefit you or not? So do take a calculated judgment on this, and don't just do it arbitrarily. Overall, this is what crypto taxes are at a very high level. It might differ from country to country, but some of the principles at least are broadly what I explained today. If you like this video, please like and tell me in the comment section what you think about it. Subscribe to the channel and tell your friends about it. Welcome to the Wave Crypto Club. Stay tuned for more such amazing videos.